There he is.
Hey,
Needs
fellas.
no introduction, but I'll do it anyways. Ryan Dietrich, Chief Market Strategist at the Carson Group. How you doing today, Ryan?
I'm doing well. I have a reputation to have this all as one big run-on sentence. So I'm going to do my best.
I love it. I
Not
love
to
that he can go
disappoint.
in one. We always said if you weren't working with its Chief Market Strategist Carson Group, you'd have been an auctioneer.
Well,
Because you can speak quickly, clearly, and concisely. Those are gifts. This is why you're on CNBC. This is why you're on Premarket Prep. You are a gifted speaker here, Ryan, and we love your content as well.
well, I said if this stuff doesn't work out, maybe I can be like, go buy some Tide at the grocery store. People say my voice is whatever, so maybe I'll just do something like that. But I'm honored to be back. Hopefully everyone's having a good summer break. Let's do a little bit before you guys joined. I agree about PayPal. Sometimes you pay with PayPal. It's like, what is this thing? But anyway, that's all right. So do you guys see the screen about canceled? We good to start rolling?
Yeah, let's roll.
Yeah.
So we're bringing it up here right now.
Starting with a little fun, and then we'll dive in here. So we good to go?
You got it.
This is a great start. I want to know why.
Okay, here we go.
$1 million question.
This is the question. This is really
why does the UK spell everything wrong?
Yeah, bull market.
Or the US spell everything wrong.
Yeah,
who's
bull market,
wrong?
bear markets. We're all wondering, what this is what's really important to all the listeners and everybody out there. Why is it canceled with 2 L's in the UK, but canceled with 1 L in the US? Because we gave them that L in 1776. There you go.
Nice.
Happy 250 to everybody. I thought that was kind of funny. So anyway, all right. Hopefully our friends in the UK, probably a couple. Sorry. Oh, you guys are still playing. We lost last night, right? So let's just dive in. A lot of these slides and charts are slides that I shared on Monday. Yeah, Monday. Such a blur. And it's just a blur. Yeah. Yesterday with Sonu Varghese at the Carson Investor Research Team. We work with over 600 financial advisors in 44 different states. We just cracked $60 billion in assets. So I'm not a short-term trader. I'm not going to tell you what the market's going to do the next week or two. We do more bigger picture looks at things. And as most people probably know, we've been pretty bullish. And fortunately, that has played out. We're going to get into the weeds of it now. So a lot of these slides are things we shared just with our advisors this week. These are 2 big ones. I just updated. Oh, by the way, so the Dow closed above 53,000 yesterday for the first time ever. And if you look at 1,000-point intervals, it took only 4 trading days to go from 52 to 53,000. And I get it. The higher up we go, in theory, the easier it should be. Still, that's the fastest 1,000-point interval ever. It was like 31 or 32,000 back like 5 years ago was the previous fastest in 5 days. Totally kind of pointless, but then again, maybe not. Maybe it shows what's going on here with this momentum we have. But just 2 big picture ones. Each year has bad news. Every year has bad headlines. Everybody freaks out. And the market usually does okay. I know some years aren't great. I understand that, but still just important to know that. And then at the bottom right, we say don't invest your politics with investing. I've done this for a long time. In the last 18 months, I've heard so many times, oh my goodness, you see what's out of Washington, tariffs, wars, this and that, red cards, orange cards, whatever you want to call it. It's going to end it all. And fortunately, that hasn't happened yet. So just remember to separate those 2 things. Now, speaking of the orange card, making some jokes, obviously, don't fight this card, because here's what's happened under President Trump the previous 5 years. You smush them all together, you tend to have early weakness. March is usually pretty weak. I get it. There's some stuff floating out there why this is, but to call it is what it is. Just look, guys, how perfectly this year has played out relative to the other ones. You have your late March, early April low. All these, we've been bullish. We came into this year saying 15% gains on the S&P 500, and we were down 5% for the year back in late March when all these other strategists, everybody said, oh my goodness, he's bullish, she's bullish, blah, blah, blah. They're on TV saying how bearish they are. They're on TV cutting their targets. We never did that. You could argue we doubled down in late March saying we're probably going to have 15% gains this year. And fortunately, things have played out, and this is a neat way to kind of show that. How incredible is it? Well, we just gained almost 15% in the second quarter, one of the best quarterly returns ever. It's crazy. I was looking up. The first quarter we were down this year, and I know it feels like a lifetime ago. We were down like 5%. in first quarter. Nobody really remembers that, but it is what it is. But just an incredible quarter, but even layering it on, this is a chart I've shared with you guys for a while over the years. And again, thank you so much for always having me back. I always have a blast talking to you. And that is the greatest intro song. I didn't even recognize my intro song. That's an insult. I love my intro song. So I think I was just getting ready to go. But I love my intro song, so thank you. Anyway, the second quarter out of all 16 quarters of a 4-year presidential cycle is the worst on average. We just gained almost 15% during that one, right? So I think my friend Sam Stovall, hopefully a lot of people know Sam. If you don't, you need to check the incredible work he does out of CFRA. He says, this stuff isn't gospel, right? History is kind of a guide, but it's not gospel. And I know it came on, I think in April, middle of May, kind of saying, listen, major lows are probably in. Expect a surprise summer rally. No, we didn't think we'd have a 15% rally in the second quarter. But listen, we've been overweight equities, as I've laid out, and we're going to talk more about. So we are not complaining, but just kind of incredible the rally we had. Now, again, purely based on seasonals, everyone can see what I'm seeing there. Third quarter, maybe we chop around. Maybe we take a break after what we've done. I wouldn't be shocked by that. I don't think it's end of the world. But check out some of the very best quarterly returns out of entire 4-year cycle are coming up. Now, I get it. Maybe we stole some from the future ones with the gains we just had, but just stuff to think about as we move forward. Another good one, and who knows, maybe today is the day we hit all-time highs on the S&P 500, because obviously small caps and mid caps and all around the globe and the Dow are hitting new highs, so it's probably a matter of time before the S&P. I think S&P is less than 1% from all-time high time we're doing this, but the only month to never see the ultimate peak for the year, and then market,
is crazy stat.
June. I don't know. I mean, it is what it is, and I get it. There's a lot of them in January, like 2022.
Or December.
Yeah, in December kind of makes sense, though, right? Because usually we're in a bull market. So that is the peak, right? If you have a good year, like the last couple of years, you peaked in December. So it's not like shocking to see that, I don't think, Dennis, when you have the kind of the goalpost.
Yeah.
But still, the fact that June's never been the peak, we've been sharing, even with the, we had about a 5% intraday pullback back in June. Everybody freaked out. Everybody got worried. We were saying, listen, it happens. It'll happen again. Just know June's probably not the peak, and we don't think it is. Now, I know people hear what I talk about and what Sonu Varghese on our team talks about. They think we're just like these perma bulls. And yes, we have been bullish. But literally in February and March, I was all over the place on CNBC and on our podcast, Facts versus Feelings. We were talking about a banana peel sell-off in February and March. I said that we might have a 5 to 8%er. We had 9.1. Can't get them all right. But don't panic. And then things got a little too extreme with all the war and everybody getting all freaked out once again. And sentiment was too lopsided in late April. We rallied. Well, we were out there again saying, expect a June swoon. Now, I wasn't saying like a massive sell-off, but, the late part of June from the 17th to the 27th or 28th is usually seasonally weak. Well, the S&P was down 7 out of 8 days there and down like 5 or 6 days in a row. Not by a lot, but it was normal to have that. And what just happened, I didn't add it, but I was looking at it last night, that AAI sentiment poll, and I get it. There are flaws with this potentially. We had the largest drop, the second largest drop in the number of bulls going back since Liberation Day from I'm going by memory, guys, 45% down to 31% bulls. That's a big drop. The NAAIM, active managers, had one of the largest drops we've seen in a couple years. Now, there's other factors to sentiment, yes, but to have a normal June swoon, and my friend Jeff Hirsch, Almanac Trader, Stock Trader Almanac, I'm sure I got his book in front of me somewhere. Usually I do. Anyway, I look at it every day. He says, listen, that June swoon's good because then you get to the part of July that kind of shakes out the weak hands, and July is usually strong, which I'll talk about soon. So it wasn't a shock to see some weakness in late June, just like we did, get everybody all bared up and all worried, and then boom, look what's happened. We've kind of rallied again. So file this under not bearish. I've shared these with you a few times. I love to look at advanced decline lines. How many stocks going up versus down on a cumulative basis? This is not a short-term indicator, more of a big picture indicator. Just yesterday, New York Stock Exchange advanced decline line, common stock only advanced decline line, mid-cap advanced decline line, all hit all-time highs. S&P 500 just barely missed it, but hit it last week. Mid-caps just barely missed, hit it last week. There's something called the global Dow, which looks, again, I don't know all the components, but looks at like the globe, looks at a lot of different places. That also hit an all-time high. So market breadth leads price. If you look at the if you look at the New York Stock Exchange, look at the New York Stock Exchange with the NYSE advanced decline line going back like 50 years. When you hit a new high in market breadth, on average, the S&P 500 peaks 11 months later. I can give you one that's shorter. I can give you one that's longer. Just know that market breadth, new highs, tends to suggest price will follow. With the S&P 500 last week hit new highs on that advanced decline line. We don't think it's going to be any change this time, and new highs are on the way. So kind of the stuff I'm known for, you some fun ones here. Momentum begets momentum. I feel like a broken record. Been saying that for 3.5 years now, but I'm still saying it, and it's still the camp we're in. You can see on the left, which one I'm going to start with. Let's see here. Is that okay? Oh, when the second quarter is up more than 10%, which normally the second quarter isn't that great, but we just said it's up 15%. Check it out. The third quarter is on lower only once, and the fourth quarter, interestingly, has never been lower. You can see the returns the final 6 months higher most of the time, up 12% on average. Those final 6 months, more than double you're at any time final 6 months. So again, a good second quarter, something to smile about. On the right, the sweet spot. And I looked at what I shared with you guys a year ago. I shared this last year with you. The sweet spot is when you finish between 5 and 10% at the middle of the year. So a good year, a solid year, but not like a poor year by any stretch, and not a spectacular year, because there are some years like 87, some other ones, when you're up like 15, 20% the first half of the year. You know what happens? Second half doesn't do as well. So we're calling this the sweet spot where we are. Again, it is what it is. You can see what last year did when we were in the sweet spot like this time. You tend to do pretty well going forward when you have a solid year, but not a spectacular year at the middle of the year. Two more. We'll go on the one on the right first. 41 times we've seen. I look at all of them now. All the quarters that had a 10% return. What happened next quarter? Higher 85% of the time. That next quarter. What happened 2 quarters later? Higher 85% of the time 2 quarters later. Again, just something to think about when we go here. Then the one on the left's a real cool one. Again, I saw Jeff Hirsch did a similar variation of this on X yesterday, so shout out to Jeff. Gave me the idea. I joke about research, and I see this with my stuff too. If you take it from one person, it's called stealing. But if you take it from everyone, it's called research. I live by that. I get a lot of good ideas from a lot.
AI does.
Yeah, exactly. I get a lot of good ideas from a lot of smart people. And again, this is building on what Jeff did yesterday. When you're down in a quarter, like we were in the first quarter, and that next quarter is up double digits, so we'll call it a slingshot, that slingshot effect. What happens next? You see it right there on the left. A quarter later, higher, 16 out of 17 times. That's this quarter right now. That's maybe it's not all that great of a quarter historically. Just stuff to think about. That this rally's probably okay. And then 2 quarters later, which in this case be the rest of the year, higher 15 out of 17 times. Pretty solid returns. July, I'm sure other guests have said this, only spend too much time on it. July is higher the last 11 years in a row, higher 13 of the last 14 years. There's no better month the last 20 years. I think it's the second or third best the last 10 years. It's like the 4th best since 1950 and like the second or third best in a midterm year. Long-winded way of saying, I'm not fighting it. What we're seeing here, we expect this summer rally to continue. Yes, and then when we get into August, and August is that squirrely month. I'll come back on to you guys in August. When you have these out-of-the-blue events that can take place, especially in the midterm year, we don't even know what it's going to be yet. It could be anything. Remember, who could forget in 2024, the yen carry trade unwind, that first Sunday night, we all go to sleep knowing Japan was having its worst day since 87, and our stock market was down 3 or 4%. Global stock market's crashing. It's like a footnote in history now, but if you were around in August of 2024, that was not a comfortable Sunday night. I don't think a lot of us slept that night, but we got through it just fine. Anyway, just things to think about. But for now, July is strong. Oh, here we go. This is just another way of showing across the board July strong. Now, the question is why? Listen, I could give you 10 answers. I think it's earnings season, right? Earnings season kicks off in July. It is what it is. Vacations, low volume. And again, August seems to have these crazy events take place. Then September is when the hedge funds, everybody comes back. You get more volatility. There's randomness to it. Yes, but just kind of put some context around it. I don't think this surprise summer rally's done. One thing I know, Tom Lee, I'm a fan of Tom, and I know a lot of people know Tom. He's been saying like maybe a bear market later this year. I don't see that. I want to be clear. We think maybe a 5 to 8% modest pullback sometime in September, October, pre-election stuff would be perfectly normal. But that 9.1% peak to trough that we saw earlier this year, I think very well could be the largest pullback we see this year. Doesn't mean we're not going to have another 5%er. I think we will. In fact, I hope we do sometime in the fall to get everybody all bared up and then get through the election and keep this bull market going. But just some things to think about how we're seeing the world right now. I update these. My friend Sonu updates these all the time, but how in the world are we higher with crude oil doubling overnight like it did? I know it's come all the way back. I get it. Inflation stubbornly high. You got the Fed uncertainty, Washington uncertainty, blah, blah, blah. The war going on. It never feels like it's going to end. It's because of this, because profit margins and earnings, we call these the dual tailwinds to a bull market. Carson team, and we release next week our mid-year outlook. You know, we do this big picture stuff. If you follow me on Twitter, if you listen to the podcast, you kind of know what we're going to say already. But for 3 years now, I've shared these two charts and write the same section in our outlooks, mid-year and big one at the start of the year, and called the dual tailwinds to a bull market, earnings and profit margins. Eventually, they're going to peak. Yes. Don't think we're there yet. And we watch this literally every day as the data comes out from FactSet. It doesn't move as much, when earnings season's not kicking off like it is now, but earnings season kicks off in a couple weeks. Just keep watching that, more positive negatives. I could spend 3 hours on this. This is cool stuff that Sonu does. On the left, what's driving the gains this year? It's earnings. You can have multiple expansion. Listen, S&P 500 multiple started this year is like 22.5. It's down to like 20 right now. Well, how's that possible? Because earnings are up 18% this year. Mm-hmm. So you've had a multiple contraction. Just think for a second, if the Mag 7 actually starts to participate again, which I think they're going to. Everybody and their mother noticed a week ago, oh my goodness, the Lag 7, everybody's kicking them when they're down. And I've done this for a while. I know a lot of listeners have, and you guys clearly have. When you start seeing the media and everybody start kicking something, calling it the Lag 7 again, and believe me, it deserved to be called the Lag 7. Yeah, well, exactly. But the reality is maybe they take back the baton and now semiconductors do what they do. Maybe that just swishes around. But just imagine if multiple expansion were to take place second half of this year and the Mag 7, not Lag 7, Mag 7 were to come back. Yeah, who knows? But that'd still be, I think, a net positive. But Sonu shows earnings are driving this stock market. One of our favorite factor plays, so we manage about $8.2 billion on our team. I said, Carson, overall, $60 billion. Financial advisors say, hey, you guys manage a team. We have a 15-person team. I'm not a portfolio manager. I'm a strategist, but I work with smart people. I know enough to be dangerous, how we do our models. We have liked the momentum factor for years, right? And when people hear momentum factor, they think, oh, that's all AI. Yes, there's some AI components to it, but it's not all AI. There's other things in momentum. We've had an overweight to momentum factor, and it has been an incredible move. Literally the last 3 years on the bottom right, we're in the 100th percentile for the momentum factor relative to the S&P 500. Not a shock. If you pay attention to this stuff, momentum has done incredible. It's helped our models, helped our performance. We still have a little overweight. Now, listen, when you start talking about something in a 100th percentile, I get it. That's where you got to start to think about, should we do something here? One thing, we're a little bit overweight healthcare. Trust me, I've known you guys for a while. I've not said that for a long time, right? We're doing some things. We have some low volatility over here. We're doing some things where we've done pretty well with the money we run. Being overweight equities and being in some areas have done very well. We've been overweight technology. We've had some of this stuff, right? We called our outlook at the start of the year, ride the wave. Well, the one that comes out next week, our outlook is called Still Riding the Wave. We still think this AI wave is alive and well. We still think Mag 7 is going to come back. We still think it's a bull market, yada, yada. So anyway, but just know that we've seen an incredible move in momentum factor, which we're not complaining about. But when something's in the 100th percentile, maybe kind of ring the cash register a little bit, which are things we're doing as we're moving into some other areas. Still overweight equities, yes. But again, looking at some other areas. This is kind of, I think it's neat. When you manage portfolios, you got to know what you're doing. And I'm not a portfolio manager. Luckily, we've got really smart ones on our team that break this stuff down. You think about, is it just AI? Well, is the whole market just AI? Because what we're showing here are correlations of the other 11 sectors, I guess other 10 sectors, relative to the XLK. That's technology. And you can see here, like, what's the stuff on the right, like staples and different areas. Yeah, that's not correlated to technology. But look at that. Industrials, materials, consumer discretionary are quite correlated to technology. So again, if you're overweight some of these areas, is it all one big AI play? Not necessarily, but Caterpillar's had this incredible run, one of the top performers, and it is like a pseudo AI play. I mean, Ford Motors turning into like a potential AI play. So it's just things. Listen, I'm not calling this bad, by the way. I'm not saying this is bad. I'm just saying when you manage money, when you trade, when you invest, you need to know what you're doing. So if you're doing these other areas, you might be doing just one big AI trade, which again, I'm okay with. Just know what you're up to. We can maybe even skip payrolls. All this is neat. So payrolls, whatever. One of our big calls for the second half of this year is we think the labor market is going to improve. There's going to be strength in the economy. Those are positive. But this is an interesting one because as someone with a daughter who's going to Penn State University as a freshman in like a month and a half, when she graduates, I want to make sure she gets a job. And I know a lot of people out there feel the same way. When your kid graduates, they better have a job on the other side. And here AI is taking jobs. Well, it is what it is. The unemployment rate for 20 to 24-year-olds just fell again. It's down to like 7.1%. It was above 9%, back about 6-7 months ago. So this stuff just to follow. I'm not saying AI is not disruptive, not saying it's potentially taking jobs, but we hear one of those common things about. Yeah, we're just simply not seeing it yet. Looking at the time, God, I just don't
You're
shut
doing
up.
great.
Yeah, I'm almost done. Consumer spending last month, we saw consumer spending consumption is running at like 6.9% annualized the last 2 months. Now, listen, the truth is inflation is running above wages right now. If you think about what's a problem, well, that's it. I mean, to us, that's one problem out there is maybe wages are going up, but they're not keeping up with inflation. So that's not a positive, but we're still seeing consumer spending, especially with some of the recent data. So that's something interesting. I think this might be my last one, honestly. I just thought this was interesting. Who made it? I want to give them credit. Deutsche Bank. Looks like Deutsche Bank, I guess. Cash held out there. You're looking at like over $20 trillion of cash. Now, listen, there's different ways to look at this, different ways to slice and dice it. I understand the issues with our K-shaped economy. It is real. If you've owned stocks the last couple of decades, if you owned some real estate the last couple of decades, you're probably worth as much right this second as you've ever been worth, and you're probably in really good shape. If you didn't, if you're younger, if you've had other things that happen in life that happen, it is a real struggle out there. But my job, our job at the Carson team as a steward of assets is to look at the aggregate. As we've said for 3.5 years now, there's no recession coming. I'm not saying there's not little rolling recession, different sectors. I mean, housing's in a recession, yes, but the aggregate economy is still very strong because the top end of the economy is still good. I'm not saying this is great. I'm not saying this is something we should celebrate, but as someone who manages money, I have a job. My job is to make sure what's the economy up to. The top part of the economy that truly still moves things. Hopefully most people on this type of list listen to this call are still in good shape out there. When I see $20 trillion in cash, not saying we can't have a recession for any reason. We don't see one happening anytime in the next year or so, but there's still a lot of cushion potentially out there. Oh my God, I do have more. Inflation's still a problem. We don't need to say much more than that. We came into this year saying inflation, we're having an inflationary growth. People hear inflation and think, oh my goodness, the world has to end because 22 didn't go so well. We've said all year, 3 to 3.5% inflation with an economy that hangs in there with a bull market that continues. And that's not something we're changing. Houston, we have an inflation problem. Apple, real world stuff. Apple's increasing prices, right? Because of the AI memory shortage. So this stuff is happening. Inflation is still a problem that's out there. But we look at the Fed. It might be the last one. We have new leadership at the Fed, as everyone probably knows by now. Maybe on this type of discussion, we don't care as much about the Fed. I don't blame you. But the reality is it's like, I think right there, 96% chance of a hike in October. Now, we're not making a big bet on this by any means. We're taking the other side of that. We don't think the Fed's going to hike this year. Hey, maybe egg on my face, and in October we have one, maybe even next time. But we don't see it. We do not. We think the Fed is going to just kind of run it hot. Something Sonu's been talking about. We've been talking about. Eventually, you have to pay the piper when you run it hot. But we don't think the Fed's going to. Going to cut, or I'm sorry, we think they're on pause. We think they're on pause. So again, maybe there's some potential for market movements and opportunity there to kind of fade the Fed. And it does look like I have hit the end of my discussion.
Wow.
The world's longest run-on sentence is officially over.
So much information.
Yeah, I know.
Information station right
Overload,
there.
Isn't it? Yeah, I know.
Ryan,
I have to watch it twice.
Is there a market, economic, or earnings signal that would convince you it's time to get defensive?
Yeah, great question there. A couple. So one I didn't add, but I love to keep things simple, right? I'm from Springfield, Ohio, not very smart. Just keep it simple. I like to see what the consumer staples are doing relative to the S&P 500. What low volatility is doing relative to the S&P 500. If we start to see a bid from the defensive stuff, that's maybe a warning sign. The fourth quarter of 21, I'll never forget it, right? Staples did well, utilities did well, low vol was doing great. The fourth quarter of 21, telling us maybe something was changing. Maybe there was a warning sign. Then we had the bear market 22, all that stuff. But we're not seeing that at all, right? We're not seeing that at all right now, and I love that. Also, credit spreads. I love to follow credit spreads. Look at them every single day. Triple B, investment grade corporate, all that stuff. We're not seeing any stress in credit markets. We're not seeing leadership from the defensive stuff, and then put a cherry on top. Those advanced decline lines that I look at like every single day. If we start to see deterioration in advanced decline lines, you tend to see that well before the ultimate peak, and it's a warning sign. So those three things are three things that I watch that are pretty simple to look at, and they're free, and everybody can find those three things. And in my opinion, those will give a good warning sign before a lot of trouble. I'm not saying it always works. 100-year pandemic, we didn't have any warning signs before that one happened. But overall, that's what we're watching. And the good news is we're just not seeing any of that right now. But to put I guess, cherry on top, said that already. Keep following staples relative to SP 500. If staples start to outperform on a big basis, maybe something's happening, but gee whiz, staples are continuing to underperform just as we're doing this, and it's great. So I like it. Yeah.
Wow. I got to give my ears a rest here. Ryan Dietrich, you know him, Chief Market Strategist at the Carson Group. Incredible presentation here. Thank you so much. And can't wait to talk to you next month.
No, like I said, have me back in August. We'll talk about the August volatility. But guys, it's always an honor. I'm a big fan. Thank you for having me. Thanks all the listeners. I didn't look at the comments. Hopefully everybody liked how fast I talk and everything I threw out.
They love you.
I'll be back whenever you guys need me. Everyone have a great, hopefully having some vacations, and everybody have a great summer, and let's keep this rally going. I'll see you when you need me to come back. Bye-bye. Thank you.
Awesome stuff. Thanks, Ryan.